I'm your host, Dr. Jonny Withananchi, aka Dr. Johnny Walker. Well, today's topic is another one. We're going to have an absolutely incredible speaker here as well that was going to be joining us. And we're going to be talking about the top 5 criteria or questions that you should ask about the asset itself. Like what you're investing in, right? Whether it's an apartment building or, we love multifamily real estate, but really any asset class, whether it's mobile home parks, what are the top 5 things we should be asking? Without further ado, let's bring in our guest today, and he's not any stranger to this group, Mr. Rob Beardsley of Lone Star Capital. All right, Rob, it's great to have you again. Great to see you in good spirits and in good health. Rob, I'll let you introduce yourself in a second, but Rob is a partner of ours. We partnered with Rob on multiple deals, on hundreds of millions of dollars of deals now. That even sounds unbelievable to say, but it's true. He's a founder and principal of Lone Star Capital, which is an absolutely rockstar firm that's focused on Texas-based multifamily real estate. But Rob, I'll give you a couple moments here to kind of fill in a little bit about yourself, anything that I didn't mention, and then we'll get right into the topic here.
Sounds great. Yeah, so hey everybody, my name is Rob Beardsley. I'm the founder of Lone Star Capital. We're a New York-based multifamily firm investing exclusively in Texas workforce housing. We, over the last 6 years, have acquired $600 million in multi-assets across the major markets of Texas. And more recently in 2021, we launched our in-house property management company, which is based in Houston. So we have just taken this approach to be super focused from a market perspective. But I'm also excited today to talk about how we get focused and really look specifically at the asset itself when we're acquiring property.
Awesome. Excellent. So did I hear you right? Did you say $600 million of multifamily real estate assets under management?
Yeah, that's right. It's we're getting there.
Wow. Good for you, man. All right, Rob. So our topic today is, we're all about empowering doctors, dentists, to get out of the stock market, right? Look into real estate, start investing passively, developing passive streams of income, building wealth in a predictable manner, and getting tax advantages, because let's face it, we're probably the highest taxed of all professions. So now when we're in an investment, we talked about the market, we talked about the sponsor, but the third most important piece is the asset itself, the product that you're investing in. Now, Rob, as a passive investor, I'm a dentist. I have very limited real estate experience. What are some questions? Let's break it down here. What are some questions or criteria that a passive investor might ask? Just to find out the right information.
Yeah. So the thing about diving into the specifics of an asset is you can really get lost in the so-called complexity of a deal, because deals, if you really dive in, can be quite complex. But obviously, as a passive investor, you don't want to give yourself a second job here. So you don't want to have to go through every single number. So you really want to focus on the highlights and understand the deal holistically after, of course, like you said, vetted the sponsor, vetted the market, everything checks out there, and you're just doing kind of the final check to see if this investment in particular is in alignment with your goals. So I think that's really the first place to start, is to think, what are my goals as an investor? Am I looking for tax benefits? Am I looking for capital preservation? Am I looking for cash flow? Am I looking for an opportunistic return where maybe I'm taking some higher risk, but there's a really strong potential for a big payoff, right? You don't just want to go into a deal and have someone tell you that it's a good deal. You should know what a good deal means for you, because maybe a good deal for me is not a good deal for someone else, right? And that just depends on what your goals are and where you are in life. So that's the first thing to understand, is every deal is different from that perspective, and that doesn't necessarily make it good or bad. But and specifically what I'm talking about is you want to look at the profile of the investment. And once you start looking at a few of these, you'll really understand what I mean when I say profile, because yes, every deal is unique, but you can mostly lump deals into a category at the end of the day. And those categories are typically core or stabilized, and value add or opportunistic. That's kind of, just to go to real high level, those are your 2 broad categories. Core or stabilized investments are ones where the property's already built, it's already performing well, and the business plan is really just to take over and continue the success of the property and focus on its cash flow. And hopefully you're buying in a good market with growth, and you'll eventually sell at a profit as well. But you don't really have an aggressive business plan to force appreciation or to drive up income. That's a value add plan. And a value add plan is very popular with investors because you can achieve greater returns through a value add plan, but it's also more work and therefore more risk. So understanding the correlation between risk and projected return is super important, and unfortunately something that I see passive investors really miss. And that's, I think, if we do our job right on this video, it's really helping people understand and appreciate risk when they're looking at potential deals.
So now, would you value add? Now, would core, stabilize, value add, and the last one you mentioned was opportunistic. Would you lump opportunistic with value add, or that's a higher level of a value add with an opportunistic play?
Yeah, I mean, that's typically a higher risk strategy and just a higher level of value add, right? A value add could be the interiors are 10 years old or 20 years old and they're tired, and you're going to go in and spruce up the kitchens, new flooring, new paint. And that's a pretty straightforward business plan where you're just basically doing like a house flip 200 times on a deal, and you've got the property down the street that already is renovated. So it's a super straightforward business plan to wrap your head around. Opportunistic, on the other hand, would be something that's more risky and perhaps less proven. Like, for example, you're buying a property that was run to the ground by a slumlord, and there's mold issues, and there's roof leaks, and there's crime on the property because it's just been a downward spiral, right? There's gonna be a lot of unknowns. Once you start getting involved, you never know what's gonna happen. You're gonna figure out, oh, a certain tenant is dealing drugs out of this unit, and I have to clean this part of the property up, and you start repairing the roofs and you realize there's more cost, right? So that is definitely higher risk, but hopefully if you buy right, you actually can potentially get a better return. Where I get nervous is when I see people get excited about a business plan or the potential for a turnaround, but they're overpaying for the asset or over levering the asset. So those are the things that I watch out for when I'm looking at deal specific numbers.
So now, I mean, I already know the answer to this question a little bit, but so why is it that Lone Star Capital doesn't, I mean, to my knowledge, doesn't do these opportunistic plays? Is there a reason that you as a firm stray away from these type of deals? Or I know that your focus mostly value add, and very recently in some more stabilized stuff too, right? With the higher quality assets that you have been acquiring. Is there a reason that you kind of stay away from the opportunistic, or have you? Maybe I'm misspeaking.
Yeah, it's a good point. And earlier on in our acquisitions, we were focusing or trying to focus on more opportunistic stuff. And that was in part because we wanted to pursue higher return deals so we could really impress our investors. And I think you see companies generally start in that regard, as they start in Class C properties and then work their way up to Bs and As. And I think also they're not just working their way up, but they're also over time building a bigger appreciation for just how tough and sometimes risky older properties are, right? There's a reason why older properties are cheaper than newer properties, right? Because there's more risk there. And when you're young and just getting started, you haven't been there. You don't have the experience of having a chiller go out on you and you have to spend 100 grand, 200 grand on replacing chillers, right? Ouch. So those are things to keep in mind, or chasing you as you get more experience. You go, you know what? I'll actually take the lower return on the nicer deal because I think in the long run, that will pay off more. The other part of that is when we started buying deals in 2017, 2018, that was a different market than where we've been over the last few years. And what I mean by that is there was less competition and there was more opportunistic opportunities out there that were priced appropriately. But then as the market gets really hot, basically the pricing difference between an A deal and a B deal and a C deal gets really tight. Everything gets overbid. So the price difference is minimal. So it's a pretty simple question, right? If someone's offering you an A class property and a B class property and a C class property at around the same price, it just makes the most sense to take the nicest deal for around the same price. And that's the dynamic that we've been seeing and we've been benefiting from more recently. However, I'll end on this. We've been in somewhat of a real estate recession over the last about 2 years, given the dramatic rise in interest rates. And now that these interest rates have been high for so long, we're starting to see owner operators of lower class properties start to struggle. And they're starting to see their operations get hurt. And some of these deals are going to start getting foreclosed on, as they have been already. And these banks are going to start selling these properties. And you know what happens when a bank owns a deal, right? They don't manage them well. So it only gets worse from there. So eventually those sell at a deep enough discount and there's enough trouble at the property where it all of a sudden makes sense to go in and do opportunistic stuff again. So I think that speaks to the ebbs and flows of the market. It's one of the reasons why I love the business so much, is every day is a new day. The market's always different. And so we have to adjust our strategy based on what we think is the best thing to do at that point in the market.
So as a dentist, right? Like, where do you think that a dentist should invest? It should be more along the more conservative stuff, A's and maybe some value add versus some core versus, opportunistic? Or, I mean, just if a dentist is trying to figure out a strategy, I mean, what would kind of be your recommendation?
Yeah, I think it's a tough question because it's really hard to replace the expertise of being a professional, right? I'm not trying to go into the dentist's office and tell them what to do in that procedure, right? And so on some level, I want to similarly flip it around and say, well, you shouldn't be going in and telling the real estate guy what to do either, right? But obviously it's a little bit of a different relationship because it's the dentist's investment at the end of the day and you have to match their goals. So I think understanding your goals, like I said at the beginning, is really important. So if you're a younger, more ambitious dentist and you're looking to invest the capital for the long term, I would recommend pursuing more opportunistic type stuff or potentially deals where there's not as stable of an immediate cash flow. But if you're older and you're looking to retire on the cash flow, then that's what you should be optimizing for. You should be buying the new deals with stable debt that are focused on capital preservation, because later in life, you don't want to take a risk. You don't want to take a loss. So it depends on where the dentist is in their career and what their goals are for the investment. But at the end of the day, like I'm kind of been saying, just because a deal is opportunistic or just because it is stabilized doesn't make it good or bad. It's just a different fit. You can make a stabilized deal a risky deal by paying too much for the asset or putting too much debt on it. And then the same goes for an opportunistic deal, right? Just because a deal has a compelling business plan where you're renovating the kitchens and you're showing all the before and afters, that doesn't make it a good deal.
So Rob, you mentioned now looking at the profile, right? I mean, what else? What would be the next thing that you would kind of look at? If if most of us as dentists, we're gonna get a offering. Hey, look, we got the shiny investor deck. I'm looking at this deck. It looks great, but what would be the next thing that I would ask at the property level?
Yeah, at the property level, you want to understand the business plan. And I know we've been talking a lot about the business plan, but that's because it's so important that the business plan is in alignment with the deal and with your goals. Because if the business plan is to renovate the property and raise rents, but if you look at the nearby incomes, median household incomes, and that's a stretch for the median household income to afford the higher rents, I don't like that plan, right? So it has to be in line with the market. It has to be the business plan has to just make sense, right? And so that's something that we really don't like to push the envelope on. For example, pushing rents and transforming the asset and being the highest rents in the neighborhood, right? We would rather find a property that's lagging the market and just renovating it and managing it better so that it has rents that are kind of in line with the market. That's our strategy. So I get nervous when I see deals that are making the new highs of a market, if you will. And like you said, with higher risk, there's the potential for higher reward. So for some people, that might be an exciting deal, and that's the risk that they want to take. But for us, that's just generally not where we feel the most comfortable. So that's what I would be looking for. I would also be looking for, if you are venturing into older property, which I'm a fan of, because there can be better opportunities when you're buying overlooked deals that are a bit older. For example, right now and what does older mean? So I'll explain. For us, we're buying a property right now that is a 1972 built property. Now that is older for a lot of people in the business. That is an older property. Typically people like to buy deals that are 15 to 30 years old to maybe 40 years old. So a 72 vintage asset is quite old. But it's not just the age of it. We looked a little bit deeper and we looked at, okay, what's the roof like? Is it flat? Is it a flat roof? Is it a pitched roof? What condition? Something really important when you're talking about older properties like this is wiring. Is it copper wiring? Is it aluminum? Is it aluminum that's been remediated? And then also with older properties, you have the potential for foundation issues. Plumbing is super important. A lot of the deals in the 70s have cast iron plumbing, and that stuff just rusts and cracks, and you just have forever problems, and you're always replacing. So the deal we're buying, for example, even though it's older, it has PVC plumbing. That's incredible. And then, of course, with older assets, you also have the potential risk if they have boilers and chillers. Like I mentioned earlier, we've had properties that are older and a chiller goes out. Well, that's a big expense that you have to pay, and hopefully that chiller lasts another 20 years. But when it hits you in that moment, you have to pay that bill. That can be painful. So you want to budget accordingly and be prepared. So I know that's a lot that I just threw out there, but being comfortable with the property condition is important. And for some people, that leads them to say, well, I only want to buy a property if it's 1990s vintage or newer. And I think that's fine. But I think also if you're willing to kind of look a little deeper at the story like we are doing right now, you can find some hidden gems that are older, but still a great opportunity.
Now, if I'm an investor and I'm hearing what you're saying, how do I know that that sponsor can work that asset, right? Like say it wasn't Lone Star Capital, say it was ABC Properties, and they tell me, hey, you got this pro forma, it's a 1970 vintage asset. What kind of questions might an investor ask to maybe vet these? Would they ask about these very property, specific level type of questions? Is this something that is beyond the purview of a doctor that's trying to invest in a deal? I mean, just a quick comment on that.
Yeah, I think it depends on the individual. I think that goes back to the really important conversation of focusing on, betting on the jockey, not the horse, and having that relationship where you trust the sponsor. But yeah, it's still important nonetheless to ask the deal specific questions. And if it is an older property like that, you say, hey, what makes you comfortable with the age of the property? And similarly, regardless of the age of the property, regardless of where it is and the business plan, it's really valuable to say, to ask, what experience do you have managing a deal like this and implementing a business plan like this? Because we have a track record, like you said, we've acquired over 600 million in deals. Well, what if that was all, I don't know, self-storage deals or something? Or what if that was all multifamily? And then I came to you and I said, hey, do you want to invest in my self-storage deal? Right? I mean, it's not like it couldn't work out, but you would have to look at that self-storage deal a lot more carefully, given that my track record doesn't back up that business plan whatsoever. But if you saw, thinking about another deal that we're buying right now, we own 1,000 units in a 10-mile radius. right? And that are deals that are similar with similar business plans. It's very much so plug and play. That is a really powerful thing to be able to say to investors. So if an investor's wondering about that, they should be asking, hey, have you done a deal like this before? Do you own any deals nearby? Do you have business plans that you've executed in the past that are similar to this business plan?
And that was a perfect segue into what I was going to ask you next. Is it seems that dentists nowadays, right, with this private offerings and just kind of really doctors getting more and more involved with private offerings and realizing that the advantages of these private offerings versus the stock market, for example, we've had an enormous amount of doctors move to this space. We saw an acceleration of that, especially in 2020. When the pandemic happened, we had all these doctors flush with cash. The government was giving out millions of dollars to dentists. And all of a sudden, there was all this liquidity, and they were very much looking for deals. And I think there was a record number of 506c filings in 2020 compared to all the previous years. So the popularity has exploded with doctors. But my question to you is, how do you choose which asset class you go into? I know you might be a little biased, but it's like a doctor has an opportunity to go with self-storage. And then there's RV parks, there's marina deals and mobile home parks and assisted living. I mean, it's almost like there's too much out there now, right? It's, do you have any insight on how, what asset type you might even invest in?
Yeah, there's definitely pros and cons of these different asset classes. However, they're not that different from each other, most of them. When you're talking about alternative investments, and even when you're talking about investments that include private equity outside of real estate, when you're talking about even investing in the stock market, these are all, generally speaking, investments that are pro business cycle and pro interest rate cycle. When interest rates are low, these businesses and investments and stocks typically do better. When rates are higher, they typically do worse. When the economy's up, these investments are up. So even though we all think that we're diversifying ourselves when we're putting money with a multifamily investment and a self-storage investment, those are two very similar exposures at the end of the day, because those are exposures that are most of the return is coming from interest rate risk or interest rate exposure and the U.S. economy exposure. So I would say that there's not a ton of there's not that much to be worried about. Like if you have a lot of investments in multifamily because you just so happen to make a good relationship with a multifamily sponsor, I wouldn't have a hard time sleeping at night thinking, oh my gosh, I didn't diversify enough into self-storage, right? Because they're similar. So at the end of the day, I would be looking for what makes sense to you, who you have the best relationship with. Because if you have a really good relationship with a mobile home park operator, I would go with that one, right? If it's a multifamily operator, I would go with that one. I think the relationship is really the powerful thing. It's access to the sponsor, access to the deal flow. And at the end of the day, I think this is it's such a big point to remember, like you said at the very beginning, tax benefits. The government puts so many incentives forward for us, all of us, to be investing in real estate. It's hard to do anything else. One more point about that. You have to remember, when you're talking about investing in stocks or in even hedge funds, like more sophisticated public securities type stuff, you're competing against investors like the Harvard Endowment and like pension funds. And guess what? Those investors, they don't pay taxes, right? Those are non-taxable entities. So they don't care about the tax inefficiencies of investing in stocks. But we as individuals, we care. We need to invest in real estate. It just cannot make any more sense to go to real estate than anything else, given that advantage.
Yeah, that's huge. I mean, like, we are the highest paid and we're the highest taxed. Rob, any last insights before we sign off?
Yeah, I think it's a really interesting point. Obviously I'm biased, like you said. I'm only focused on Texas multifamily, but I've seen other sponsors in the industry and I've seen other presentations for different asset classes, and I think it's important to remember that when you're getting pitched on a deal, because multifamily is so amazing, there's a housing shortage, people are renting for longer, people aren't getting married as much, there's just more demand for rentals. So when people are pitching you that,
millennials are more likely to be renters than buyers too, right?
Exactly. There's all these amazing things about multifamily, but you have to remember that those aren't secrets. That's priced into the market. So when you're investing in a multifamily asset, the other bidders that competed for that asset also knew those awesome things about multifamily. So it's not like you're getting in at this super cheap ground floor level, and then when you sell, you're going to make this big profit. I mean, you still can, but it's not like those things make the deal unique. Similarly, if someone's pitching you a mobile home park deal and they're saying, hey, it's NIMBYism, which means not in my backyard, right? They're not making any more mobile homes, right? For every asset class, there's all these pitches why it's so amazing, right? For self-storage, they say, hey, there's no tenant to worry about. It's just 4 walls. It's super simple. Every asset class has its pitch, but you have to remember every other bidder in that space is bidding on those same assumptions. So whatever price you paid in, those things are going to be true on the way out. So those high level pitches to me don't resonate with me. I don't get excited when I hear that. I want to know, yes, I know that mobile homes are great, whatever. I want to know specifically, what are you doing that makes it great, right? Not just that the space in general is great.
Yeah, that's great. And, you know, last question, you know, I'm just thinking about it from a perspective of an investor, right? Like now you have a nice shiny investor deck. How much should we be looking at, so like in your decks, right? When your deals, there's a breakdown of comps and rent comps, and it's this big spreadsheet with a lot of numbers. You know, how much should we be delving into that, or should we, and what level of understanding should we have of all these numbers and metrics and stuff like that? If, you know, for a lot of us, we could tell you, what a MOD amalgam is, or what a sinus lift and placing, making a lateral window with bone graft and placing implants. But then when you talk about this stuff, it's completely, I have no idea what this is. I mean, how much do we need to go into the details of these numbers?
Yeah, I think it's that balance of, you want to know more and you want to have the confidence in the deal, but you also don't want to create a second job for yourself. So it's finding that perfect balance. And I think it just varies on the deal, varies on the relationship you have with the sponsor, the track record they have. But what I want to know, if I'm just high level investor that doesn't want to spend a ton of time, I want to know the deal structure, the fees that the sponsor is charging. And as a dentist, it's really important and super valuable to be a part of this community and to actually have the insight as far as what's normal and what's not normal for deal structure, deal fees, and profit splits and things like that. I want to know those things because obviously it's important for my returns, but also it tells me something about the sponsor. If a sponsor is charging a 3 or 4% acquisition fee, which depending on the, in my space of multifamily, institutional multifamily, that's not market. That's not normal. That's a high fee.
And some guys try to do it too. Yeah.
Yeah. And power to them, right? It's amazing to be able to earn those high fees, and maybe they're doing something special to earn it. But what that tells me about the sponsor is they're doing something aggressive, right? And it just is what it is, right? And maybe it's a good thing, maybe it's a bad thing. I also want to know about the debt. If I'm going to dive into numbers and learn some technical stuff, I want to know about the leverage. So I want to know terms like loan to value, loan to cost, debt service coverage ratio, fixed versus floating. I want to know those things because debt is the greatest source of risk in real estate. And
Amen.
It's easy to kind of manipulate the numbers and hide the risk and stuff like that. But if you just really look at the debt and figure out, does this debt make me comfortable? What's the downside scenario? That to me tells a lot about the sponsor and the risk of the deal.
Yeah, that's very good. If anybody got value from this, drop a fire emoji in the comments right now. That's super helpful, Rob. That was excellent.